Let's drive the conversation forward. Some of the research out of Richard Clarida at Pimco. We needed to recalibrate 24 hours ago. Now, with a vengeance, we must readjust. Richard Clarida is out front of us with recent update and path-breaking work on our economics, and particularly on some of the phrases of the moment. And one of them is going from new normal to new neutral, which to me goes to our future terminal value, where our numbers are drifting to, the glide paths of where yield will be. Where will it be?
Well, our view is that for a variety of reasons, slow growth, an overhang of leverage, re-regulation of the global financial system, we're in a world where policy rates by the Fed, other central banks, are going to be low for a long time. In Europe, they're negative. In the U.S., the Fed will be hiking, but to a much lower destination than we observed before the crisis. So we think a neutral policy rate for the Fed is somewhere between 2 and 3%. Nominal. Okay,
when you taught Econ 101, Chapter 14 was on finance, and Steve Bodie's name was in there, and a bunch of other fancy people. What is the ramifications economically of a new set of low interest rates? Does it diminish our animal spirit?
Well, the goal is actually, by keeping rates low, it's reflecting the fact that there's a deficiency of aggregate demand globally, and there's also a slowdown in potential growth. It's an attempt to support the economy in the face of still the headwinds from the financial
Can you be
crisis.
that cautious, Drew, or do you disagree, or are you going to be more optimistic?
We think that we're in a little bit of a catch-22 with our call, because at UBS we think zero rates, at the zero bound, odd things happen. People save the spendings from the savings from gasoline, right? They save that instead of spending it. And part of the reason they save that is because the one thing that's actually gone up dramatically in price is the cost of retirement.
As the European Central Bank continues to stimulate, is that going to have an impact on the U.S. economy any more than it has, up to now, Drew?
We don't actually see too much in the way of a feed-through from there. Pretty much our model suggests that for every 1% increase in European growth, the U.S. benefits by 1/10 of a percentage point. So, I mean, the U.S. is an incredibly insulated economy, and so it'll help, but it's not going to move the needle that much.
One caveat is that global bond markets are linked. So as the ECB chops the left tail risk, bond yields go up, and that translates into higher U.S. yields. So the long end of the U.S. yield curve is not pinned down by the Fed. It depends on global developments as well.
And you did see that the other day. I had clients going, what happened with Fed expectations? I'm like, nothing happened with Fed expectations. The Boons sold off rapidly.
Because of Greece.
It's funny because a lot of equity clients now are like, what's this Boon thing? And like, how does this impact the U.S.? And do you have a model for Boon yields do this and 10 years do this? And we don't have models on that, but clearly there's a linkage.
That's now my new message 9, my header on the Bloomberg email terminal, which is, what's this Bund thing? Rich, I was at the Institute for International Finance conference yesterday here in Manhattan, and in the halls, the whisper you constantly heard was, liquidity, liquidity, liquidity. Are you worried about liquidity?
Well, the reduction in liquidity in markets is a fact of life, and it's a direct consequence of the re-regulation of the financial system. I'm not saying it's a good or bad thing. It's a reality. And so what that means is that we're more susceptible to vapor locks, flash crashes, because there's less liquidity provided by intermediation in the system, and that was a direct consequence.
You see this as a consequence of regulation.
So that's the reality of markets for the foreseeable future.
Within all this mix, Drew, I'm going to ask you this with respect to Professor Clarida's decades of work in the classroom. Is any of this in our textbooks? And I don't mean what we're specifically talking about here. I mean Greece, OPEC, Lagarde, Yellen, the swirl of this. I don't observe it in my textbooks at home.
No, I mean, I think the basics are in the textbooks, and that's kind of where you start from, right? But I think that there should be, in any sort of analysis, you need to have a very healthy respect for behavioral finance tenets and risk aversion, and the fact that people are acting in a way to keep their jobs, not necessarily in an economically rational way.
They're trying to keep their jobs. Part of that's a lack of investment. When do we see investment, Richard Clarida?
Well, I think we're still waiting. The fact that the oil patch took a huge hit this year is obviously negative in the U.S. The fact is, globally, there's been a shortfall of investment relative to what models would suggest, given low rates and cash flow. And there are various theories about that, slower productivity growth and other factors. But the short answer is there's a shortfall of global investment.
One glimmer of hope here, Catherine Mann at the OECD this week saying Europe's doing better. She minced no words about it.